Hello friends, we as traders are pure capitalists. We basically want to A, make the most amount of money, B, in the shortest possible time, and C, with the most amount of controlled and manageable risks as far as possible. So that controls the downside, if any. Now, it is important that to be able to do that, you should know which instrument to trade because not all instruments will give you the same result. So, should you be trading the index futures or should you be trading the stock futures? That goes for options as well. Should you be trading Nifty options and Bank Nifty options vis-a-vis individual stock options? Now, here I want to share with you my view based on statistical weight of evidence. It would have been very easy for me to make this into a short video spanning 60 seconds, but you know me for statistical trading models. You know me for providing the when, where, why, how is what I call a 360-degree worldview. So in this video, I'm going to share with you the when, where, why, how. The indices are not half as volatile as individual stock futures. That's a given because they are average of, in the case of Nifty 50, 50 stocks, and in the case of BSE Sensex, 30 stocks. Now, obviously, the intraday volatility will not be the same. The individual stock is, on the other hand, an individual stock. It'll move up or it'll move down, and that too by significant degree. In the Indian context, on an average, the indices move between 1.25 to 1.75% per day on a maximum basis. Individual stocks, on the other hand, move between 3.25 to 3.5% on an individual day. But of late, I have noticed that 4% is getting to be somewhat of a new normal. And I've told you many a times that in 2025, I'm expecting pro-cyclical hysteresis in financial markets. There is a video on what pro-cyclical hysteresis means. It's a short 60-second video. The hyperlink is below this video. Please do watch that. So as we head towards the pro-cyclical market, individual stock futures volatility may not be restricted, or intraday ranges may not be restricted to 3.25 to 3.5%. 4% might just become the norm. So you'll have to learn to live with this. Now, you would tell me that the higher the volatility, the bigger is the probability and therefore hypothetical chances of making more money. But the reverse is also true. If you're on the wrong side of the market, your losses can be extremely outsized in individual stock futures when volatility rises. Now, there is something called the concept of relative strength comparative. When the market goes up, between the two instruments, which rises more, and when the market comes down, which falls less. So in a rising market, rise more. In a falling market, fall less. That is what we ideally want. Now, the answer to whether you should be trading individual stock futures or index futures actually lies with you as to what you want. Allow me to explain. If at all you're looking at lower volatility and somewhat of a steadier return as compared to high volatility in individual stocks, the lower volatility guys should be sticking to index futures, and particularly Nifty index, not Bank Nifty. Bank Nifty is more volatile between the Nifty 50 and the Bank Nifty. I'll tell you why. Now, look at the Nifty 50. Why is it called the Nifty 50? Because it is comprised of a total weightage of 50 stocks. All right. Now, it's not all that simple as you think it is. This weightage is not static. It keeps adjusting every month. To that extent, this is something I can assure you not too many people know, and therefore not too many people will tell you. The weightage in the Nifty 50 of individual stocks is telescopic. What does telescopic mean? Take a look at this. Remember, in the olden days, we used to have transistor radios with aluminum helical antennas. We could extend them out and then we could compress them in. out, in, out, in. So the weightage of individual stocks in the Nifty changes every month. Now, take a look at Hindustan Unilever. What do you see? The weightage of Hindustan Unilever has fallen in the month of March over the month of February. Do I need to tell you that the price of Hindustan Unilever fell in the month of March? I don't think so, because you can verify it yourself. Investing.com, chartview.com, tradingview.com, hell of a lot of places where you can see that. Now, why is the weightage of individual stocks telescopic? Because the NSE or the index management service, which is looking after the NSE indices, rewards a particular stock by increasing its weightage in a month when the price has risen in the prior month. And what happens to the stock whose price has come down? Its weightage is reduced in the following month. Now, what happens to the Nifty when you start assigning a higher weightage to a rising stock and lower weightage to a falling stock? Hey, the Nifty will not fall as much as individual stocks. Now you get it. So the index is therefore relatively made safer. It doesn't fall much. It gives you a feel-good factor. It tells you that the market is doing well. But you'd start to get severe headaches and migraine attacks and stresses and strains and palpitations of the heart if you were to calculate some of the more volatile counters, which are weighted in the Nifty itself, but they are far more volatile as compared to the Nifty 50. So here you have it. Should you trade individual stock futures or should you go for index futures? Let me share with you a small anecdote. Who do you think is the smartest investor in the stock market? And you will be surprised. It's an average bureaucrat, a babu, a government officer. Yes, they are very smart people. They know which way the winds are blowing and therefore they plan their finances accordingly. They invest their money where the shock to capital is the least. Google search as to how much money is invested in the Employee Provident Fund Organization of India into the Nifty and the Bank Nifty ETFs. You will therefore find out that these EPFOs, the Provident Fund of the central and state government employees, is heavily invested into index ETFs, not individual stock ETFs. Do I need to tell you why? I don't think so. Because I think these babus know that the Nifty is tilted to remain more bullish relatively. Remember, relative strength comparative. Fall less during falling markets. Now, when the weightages are going to be tweaked of stocks that are falling, their weightage is going to be reduced, and stocks that are rising, their weightage is going to be increased. Obviously, the Nifty will give you more safety. Now, for people above 50 years, 60 years or 70 years of age, maybe the Nifty is a better option for you. Other guys who, irrespective of their age, are looking for a bigger bang for their buck, looking for a high stakes, big losses, big gains kind of a trade-off, but who know how to manage the volatility, the risk, and know extreme amount of financial management and capital management, I think individual stock futures will suit you more. I play individual stocks more than the index because the index is very, very cushioned. It's very stifled. It's kind of made a lot more safer. It doesn't budge much. Individual stocks, on the other hand, fly around the place. But then I use a statistical trading model to help me trade trading decisions. Unless you're very savvy about which way you should be going, I think play a safe hand and go in for index trades, both in the options and in the futures space. Once you're experienced, once you know how to handle the volatility, the stresses of what happens in the market, then by all means, you can always switch your horses and start trading individual stocks rather than indices. Remember what I told you about financial markets. Nothing happens in the financial markets without a reason, And because it's a financial market, the reason is also always financial. The reason why the Nifty's weightage is telescopic of the constituent stocks is to cushion it, buffer it from volatility, and to keep it relatively higher compared to the individual stock futures. Now, whether you should take a high risk approach or a low risk approach, you are the best judge. Friends, how do you like my videos? Do let me know in the comment segment, and I would appreciate it if you can help me reach out to a bigger audience by sharing my videos with smart traders like yourselves from your social media groups, your friends and families, and help my channel grow. Before I sign off from this video, a reminder to subscribe to my YouTube channel for even more cutting edge ideas which others don't show you. Click on the bell icon to receive instant alerts about fresh videos being put up out here, and do take very good care of your trades by keeping stop losses in place. Thank you for being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off. Have a very, very profitable day ahead. Bye-bye.